Hello, everyone. We got a packed house today. I guess everyone wants to learn about permanent life insurance and how it works. So thank you for those who are on time. Appreciate it. We'll probably give it a minute, maybe two, just to let everyone get on the call here. So thank you for those who are early. Give it a minute or two. We'll get started here. Good morning or good afternoon, depending on where you're in the country. My name is Josh Elohim. I'll be your speaker for today regarding permanent product education. I'm assuming you all know about permanent products, no problem, right? I'm just joking here. Well, listen, so some quick housekeeping for the purpose of the call. Everyone's going to be muted so we can get through this smoothly. We will do a Q&A session at the end, so please put your questions in the chat box. Ask any question you want, ask away, okay? I promise I'll do my best to get to all of them, and so that way we can have this thing go smoothly. If for some reason you're in this meeting, but you don't have access to our technology, you can go into the chat box where you can click on the link. You can put in your information, and you can go ahead and get your own quote and apply software. So again, thank you so much. Take off your shoes, kick back. Let's have some fun here. Mike Runkle, how you doing, buddy? I got some exciting news for you. I want to talk to you after this. So little shout out to Mike there. So, all right, hopefully you can all see my screen. Everyone can hear me. Let's have some fun here. So everyone knows term insurance, hopefully for the most part. This permanent insurance can be tricky. There can be a lot of moving parts. We know quote and apply is relatively easy, but when we get to that lifetime button there, we do have a bunch of options. So my goal today was just to go over a few of those options, go through all of them, how they work, how do we apply them, and who's potentially a good client. Is that fair, everybody? Okay, so here's our software. Hopefully, again, you've seen this already, quote and apply, put in that information. We pre-filled this now, health class, smoker status, height, weight. I don't want to spend a lot of time on this, date of birth. And we'll just say you do have the option to get help here, but let's just say no thanks for now. And then we have term insurance, right? Hopefully this is pretty straightforward for everybody, with term. That wasn't the purpose of this call. Let's go ahead and go to lifetime coverage now. So now all of a sudden we got a bunch of different options here, and some people get confused, some people get nervous, some people get scared. So this is really where I want to be a resource, okay? What I'm going to do is I'm going to start with the most basic and get a little bit more advanced. And when I mean basic, let's focus on death benefit driven, okay? Just want to have a guaranteed death benefit for a guaranteed period of time. Hence the word guaranteed UL. So let's go ahead and click on this here. Now I call this term for life. And what this basically means, because we know term insurance normally goes for 20, 30, up to 40 years now. I can't even believe it. And so, but the problem with term insurance is that it's probably going to expire. Actually, there's less than a 2% chance of someone actually passing away with a term policy. So guaranteed UL is term for life. So look, we're back to shopping here, right? The only big difference here is now instead of going for 10, 20, 30, 40 years, look, I can go to age 120. I can go to age 100, 95. You can even go down to 85 years old. I've had cases where people's families have lived till over 100 years old. So going to 100 is not enough there. So we can do, 120. If you ever needed to, we could do 105, 110. But the thing is that we would have to do that on a custom basis. But just want you to know. And I can go down to 85 years old there. So it's guaranteed UL. It's really simple. So we have a set death benefit. So in this hypothetical, we got $1 million death benefit. We have a set premium. There it is. And then we have a set time frame. So this was year 120 is what's coming, what it starts off as. So in this hypothetical, again, it's all guaranteed. Guaranteed death benefit, guaranteed premium, and guaranteed time frame. There you go. Now there's little to no cash in these policies. That's not the purpose of this policy. The purpose is guarantees. So hopefully that makes sense to everybody. This is there's no real tricks involved here. It should be pretty straightforward here. But you have a bunch of options, all right? Now, if I change this to New York, I might have less options. But again, we have a good amount of options here for you or your clients. So when is this used? Okay, let me give you some scenarios. One of my favorites is I have a client who has a high net worth, and they're going to have a huge estate tax. Life insurance is one of the best vehicles to pay for estate tax. So you can use this. It's all guaranteed. Normally, this is done via, a shorter pay, like a 10 pay. So it could be a full pay, it could be a 10 pay, 20 pay. But this is where we see a lot of cases happen with guaranteed UL. Again, I want to make sure that my estate's taken care of. When the second person dies, they're going to have money to pay for my estate tax. Very straightforward. Well, you see this a lot with survivorship policies, where if you have a husband and wife, it makes it cheaper. So that's something we are working on for quote and apply. Right now it's just for single lives, but we are working on a survivorship option. But hence, you have to pay this after 9 months after the second person dies, you have this estate tax due. It's very common for people to use life insurance to do that. Very straightforward. Another scenario, I have a permanent policy in place. You talk to your client, you ask them what kind of life insurance they have, they tell you I have no clue. No one's ever heard that before, right? All right, so let's just say they actually know what they have. I bought a whole life policy 20, 30 years ago. It's got a bunch of cash in there. You know, I've gone from a growth phase to a stability phase now, and I don't feel like paying premiums anymore. What options can you help me out with? Well, in that situation, we would look at doing what's called a 1035. So we're just moving money from one policy to another, kind of like real estate to 1031. Same concept to avoid taxes. Move that policy over. We can look at a guaranteed UL. Why would I do that? Well, whole life policies or permanent policies can have high cost of insurance charges. They can also have, high loan rates. So I don't want to pay any more premium. You can move that money into a policy like this. There are situations where you can actually pay, let's say I was looking for a higher death benefit paying the same premium. Well, because this is a guaranteed UL, there are situations where you could actually get more death benefit. There are other situations where if you want the same death benefit paying lower premium, that's an option as well. The one we see the most though is, hey, I don't want to pay any more premiums. So what we could do is, again, we 1035 into a guaranteed UL. And a lot of the time, because that permanent policy or that whole life is so expensive, the cost, you could actually be in situations where you could get the same more death benefit and pay no additional premium all the way out to age 100. So these are some guaranteed UL sales. The most obvious is I want to have a guaranteed death benefit with a guaranteed premium for a guaranteed set period of time. Is that pretty straightforward, everybody? Just trying to keep this very simple, very high level. Please ask questions if you need to. So that's guaranteed UL, okay? Let's go back here. Now what I do is I'm going to climb the ladder, meaning that's if someone is really concerned about protection, that's really what we're looking for here is protection. I want to make sure that I'm covered for the rest of my life. Guaranteed UL. So let's pivot. I'm going to go to the next one that has, let's call it a little bit of cash now, but still more death benefit focus. This will be called universal life insurance, okay? So I'm going to run that illustration here. It's going to pop up here. Now, these products, what you're looking at here is what we call, how is the credited method towards these policies? Well, it's something what we call current assumption policies. To keep it very simple, however that carrier is doing, so in this situation, John Hancock, however their internal investments are doing, they will credit the policy with how they're doing. So that's in terms of, and that's how that works. So it's very simple. It's not based on the S&P 500 like an IUL. It's based on however that company's currently doing right now. So I can hit the show details here, and I have a bunch of information here, right, to see how this works here. And then I can also click on the policy to see, like, what is that number? So let's just click on this PDF here, right? I know we're all visual people, so let me just show you here. Now, like anything else, they can, almost like a whole life policy with their dividend, they can change this number, right? It's really up to however they're doing. So if I was to pull up this hypothetical, let's zoom in here. And I'm just going to dive down here to the meat and potatoes here. Does everyone see this policy is paying currently 4.65%? Let me zoom in here. Does everyone see that? That's the current rate that the carrier is paying. Hence the word current assumption. Who's looking for this policy? Someone that maybe needs a good death benefit, but also wants to have some cash. It's not about cash. Just having some cash here is really important for them, okay? Current assumption's been around for a while. It's a good option for someone to have the ability to have the death benefit. Now, there are carriers that still have guarantees, and this John Hancock, this product is not guaranteed. It's a current assumption. So again, that means that you have a zero column and you have a guaranteed and a non-guaranteed column. If you look here, that this is 2% here on the guaranteed side. So you see it right there. So that's what they'll guarantee. This is non-guaranteed. So let's just go back here. We have other options for current assumption, not just one. Again, who is this a good fit for? Someone who still wants to have a strong death benefit, but does want to have a little bit of cash. One cool feature about this, about Universal Life, is I can add what's called the long-term care rider. You've all heard, if you heard me speak before, you know I'm passionate about long-term care. So with this option, Universal Life, I can have that long-term care rider on this product here. So I pick my rider, I pick my percentage, and rerun the quote. Pretty straightforward. Come on, mouse. There we go. So I can add a long-term care rider, which I'm a huge fan of. To me, this is kind of like have your cake and eat it too, because you have a pool of money for long-term care. You also have a little bit of cash growing in the policy as well for retirement income, and you have a death benefit. 3 bells and whistles there. So that's current assumption. Please, if you have questions, ask. How do they decide the rate? It's just based on how that company's internal investments and how they're doing as a company. Can they change it? Yes, they can. They can change that rate. There we go. So let's get a little bit more. So now we're going to just keep on going up a little bit higher now. So now we're going to go with protection IUL. So it's still a universal life policy, right? Now the biggest difference now is now we have an IUL, or an index universal life. To keep it very simple, the way indexing works is these products have a cap and they have a floor. Caps anywhere from 8 to 12% depending on the carrier. Then you have a floor of 0. It's based on the S&P 500. So whatever the S&P 500 does it for that year, that's what you're going to get credited to your account. Is that pretty straightforward? The biggest challenge with permanent insurance is we overcomplicate it. The goal is keep it very simple. I don't want to say this is kind of like a set it and forget it, but really you don't have to do much. Every year you get a statement, your client gets a statement in, and they can see, what was credited to their account. If they want, they can watch the S&P 500 and see what it did for that year. If it does 20%, you have a cap of 8 to 12. You're not going to get that 20. But when it does that minus 20, that's when you have that 0 floor. So really you have stability because your client's going to participate in the upside of the equation, but not the downside. Now, because this is protection IUL, it still has a little focus on death benefits. So I can still go into here and I can still add that long-term care rider. Does everyone see that? So I do have that option here. This is probably my favorite. If you said, Josh, which one do you like to show the most, or what do you recommend? It'd be this product right here, because We even have more of an upside with the cash value than we do with the current assumption product because it's based on the S&P 500. But it's the same concept. Pool of money for long-term care. I have check. I can get the cash value growing in this policy that they have access to. Non-reportable tax-free income, check. And I also have a death benefit, God forbid. Before I pivot to the next one here, I do want to show you something here. And hopefully you've all seen this, but why are we having this conversation? Why are we doing this? You know, what's the reason for this? And hopefully you've all seen this potentially already, but this is a great conversation to have. Just so you know, I just helped a friend out. We're doing a case for him, and I asked him these questions. So look, we know everyone hates life insurance, right? Including myself here. But what do you hate more than life insurance? Paying taxes, right? Would you all agree? Okay, so this piece shows you my top income earners, my top tax rates. And in California, when you add this up, we're close to 50%. Hopefully none of you live in California. So when I scroll down here, I call this the bucket sheet. This is where your client's money is. So why am I showing this to you right now? Because this really helps with the permanent conversation. A lot of agents just go right in talking about insurance this, insurance that. Your clients are running from the hills here. Let's talk about a problem that everyone on this call has and every one of this call's clients have: taxes. So look at I call this the bucket sheet because here's where your client's money is. So look, you have your tax deferred bucket, your 401k. Listen, this is a great bucket. If someone's willing to match me from a company, a percentage, 5%, 7%, 10%, I'm going to put that percentage of my money into that bucket there. I have a quick story I started telling you I stopped, but about a case I just did for a friend of mine. I'll go over that in a second. So this is a great bucket. Now, our second bucket is our taxable bucket, our stocks, our bonds, our mutual funds. Another great bucket, right? Like where else can you put in 100,000 and earn $1 million, correct? There's really no other place. Another great vehicle. I work with a lot of financial planners, and it's a big misconception that, you know, we want to take this money to lower your assets under management. What it really actually does is it protects your assets under management. And I'll show you why in a second here. Then you have your tax advantage bucket, which is like your Roth IRAs. The problem with this bucket is a lot of people who make too much money, they don't qualify. That's the challenge. But it's a great vehicle, though. I always tell clients, agents, I would never tell anyone to put all your money into life insurance. To me, that'd be foolish. If you look, there's other great vehicles out there, right? So what are the challenges? This is not, I know it's all peachy and cream here, but what are the challenges with these three buckets? The challenge is, everyone see these little spigots right here? People focus on growth, but what do they forget about? Distributions. When I want to take the money out of these vehicles, what does that look like? And if I scroll down here, how am I being taxed on these three great buckets, pre-59.5 up to 70.5? Because it's not how much money you make, it's how much you get to keep, correct? So a quick story about this bucket right here. A good friend of mine, he had a company, it was his own company, and so no one was matching him. He was doing this for himself. And he was maxing it out. And I just let him know. I said, hey, that's a great job. You're deferring, great job, right? Do you think taxes are going to be going down or taxes are going to be going up? I think almost everyone will say going up, right? And we agreed upon that, right? He goes, okay. I said, well, do you know that all you're doing is just deferring and you're going to have to pay taxes on this bucket when you pull this money out? You're going to have to pay, God knows what the tax is going to be at that point. And when a light bulb went off when he realized, oh my goodness. So, and I asked him a question. I said, hey, would you rather pay taxes on the seed that you're buying, or would you rather pay taxes on the harvest? You can use that line if you want. I didn't make it up, but I think it's a great one. It's a great visual, right? So he really understood the light of what he was doing here. So now we're pulling off a piece, not all of it, but we're pulling off a piece and we're putting it into cash value life insurance. So here we go. What are the benefits of doing permanent insurance here? Well, here's the biggest one. How about what if there's a way if I could show you how to create non-reportable tax-free income? Something you'd be interested in? No one said no to that in 12 years now. So there's one more bucket you may not be familiar with, and that bucket's called life insurance. A lot of people tell me, hey, I thought life insurance was just for a death benefit. No, that's called term insurance, right? So how am I being taxed on this great bucket, pre-59.5 up to 70.5? The biggest problem I've seen with agents trying to explain permanent insurance is they just talk about it. 90% of us learn visually. Do you see how everything I'm talking about here, I'm physically showing you? So how does permanent life insurance work? Well, I can take the money out. The money grows in the policy tax deferred, and I can take the money out tax free. But again, everything I talk about, I physically show you here. This is a great piece. Hopefully you'll have the chance to use this thing. Where is it? I just go to, let me go back here. I'm in my illustration. I go show details under tax advantages. You see a link right here, non-reportable tax-free income. So why are we doing this? We're not doing this to compete with all these buckets, are we? No, these are great vehicles. What does this bucket do? It actually protects the rest of the vehicles. Because if I need to pull out 10, 20, 30 grand out of any of these buckets, which one should I pull from? I'll wait. The answer is I don't want to pull from any of these buckets because I'm going to be killed in taxes. So what are we doing here? We're creating a fourth bucket that most of your clients don't have right now. And that bucket is a non-reportable tax-free bucket. Are we doing this to beat this bucket right here? Absolutely not. No, this is a great bucket. We're not doing this to compete. We're doing this to protect. Does everyone understand that? You can see I'm very passionate about this because unfortunately, I just call this two things, by the way. I call it first a forced savings account. As Americans, a lot of us are guilty of this, but we're not saving money. So what does that mean? We're going to be working the rest of our lives. The second thing I call it is diversification. A lot of people are not diversified in their portfolios. If they have these three buckets, I always tip my hat and say, great job. If you need 20, 50, 100 grand, which bucket are you pulling from? And then I just go silent. And I show them how this works here. And then I show them that this is a bucket they can pull from if and whenever they want for whatever reason they want. And this is permanent insurance, cash value life insurance. Sorry, I get a little excited about this here, but you see which one's my favorite, right? So I can do all three bells and whistles there with this option here, right? So let's go back here. All right, we've talked about really death benefit focused insurance for the first three products here, right? From the guaranteed UL, death benefit focused, to universal life, death benefit focused with a little bit of cash. Now we talked about protection IUL, which still has that protection feature, but it really has both. And you can do that with a younger client, you can do it with an older client. So let's keep moving along here. We got a few more. Let's say your client's like, you know what, I don't need a death benefit. Or one of the things I like to do in that sale I was telling you about with a friend of mine, he had a good amount of life insurance. So he didn't need to have a huge life insurance there. So when now we're talking about accumulation IUL. So now we're looking at what's a max funded policy. So hence, look at here. This is what we call a max non-MEC premium. And it just means based on $1 million death benefit, what's the most money we can put into this policy without MECing it? Just going back for a second, what is a MEC? What does that mean? It stands for Modified Endowment Contract. Let's take you all back for a second here. Life insurance in the past was incredible. You could put $1 million in, you could take $1 million out the next day, and it would be tax-free. Beautiful thing. Well, the government stepped in and they said, whoa, we're not getting our piece of the pie here. So what they did is they created what's called the MEC, the Modified Endowment Contract. All it means is if you put on that same scenario, if you put too much money into a contract too quickly, the policy is going to MEC, making it so you have to pay taxes on the first dollar that comes out of the contract. Does that make sense, everybody? So you do not want to MEC the policy if your goal is to use this for retirement income. Now, there are situations where the MEC works. If I don't want to touch this money, it doesn't really matter. So have a look here. We're doing a max non-MEC premium, meaning the most I can possibly put in. And then what I'm a big fan of is your client's like, hey, this is great. I like what I'm hearing, but I don't want to pay forever. I can do a 10 pay. Does everyone see it? Or 20 pay to age 65. I always recommend agents, get your clients on a Zoom meeting. I'm the agent, you're the client. I can just answer all your questions right here on the spot. Watch, I just changed it to a 10-pay. I hit the rerun button. Never in the history of our business have you, the agent, been able to pivot so quickly right in front of your client. Did everyone just see how fast that was? Now, a lot of the time, this takes 5 or 6 meetings to close or doesn't close at all because you can't answer your client's questions in a timely manner. This is great, Josh. I love what I'm seeing here, but what does 750 look like? Well, in the past, you wait a week for your wholesaler to get back to you. I just put in 750, rerun quote. Did you see how, I mean, you can literally get this done in one meeting now because you can just answer the person's questions. What does 500 look like? This could be a whole week of could be a whole week of waiting here, right? This software has been revolutionary for us, for the agents we work with, and the clients. This is great, Josh, but I'm still not comfortable doing this myself. Look, I am here. I'm a wild cage animal who's been sitting behind the desk here for so long now. What I've been doing is going on meetings with you via Zoom. I'm not going to go on the application for the first few. I'll give you a few there, right? Use me, put me to the test. I'm not pushy at all. All I literally do is just educate people and spread the good news. That's it. So if you have a case that you want to talk about, you're not comfortable with your client, I'll be the third party here, and I'll help out on the call with you / for you. You're all very smart. You hear this a couple times, you're hitting the ground running full speed. If you never want to deal with it, I would potentially probably go on the app for a piece, but nothing crazy, just to justify the time there. This is very simple. It's very straightforward. If you can make it easy, people will buy this. I promise you. The case I just did is a $24,000 premium, $2,000 a month for 10 years. So it's not, people need this. They just need, the problem is that we're not comfortable having the conversations. So this is one option. I'm also a fan of, let's just say we don't need that $1 million death benefit. Your client's strictly just looking for accumulation the most possible. I'm going to change this to what's called a minimum non-MEC. Does everyone see that? So what does this mean now? Well, this is so instead of having the max, the highest death benefit, we're going to lower this down to the minimum. So there's two things that happen that your client really cares about here. First thing is that when I lower my death benefit, I lower my cost of insurance charges. Hence, so how does this work? If I have $1 million policy, I'm not here tomorrow, I buy it today, it's in force, carrier's on the hook for $1 million. So that makes sense, everyone. That's the reason why we have COIs, or cost of insurance charges, because the carrier's on the hook to pay this claim. The agent's not on the hook, right? It's the carrier. So there are fees to cover that. What are we doing here? We're doing the minimum, which is the lowest death benefit possible, because we don't need that. A lot of situations, you can get term insurance, right? You could have 2 policies instead of 1. First policy covers that death benefit need. Second policy, we can switch here now. So let's just say we already took care of $1 million of term the client needed, right? Now I pivot. Are you putting money away for savings? If the answer is yes, I go right into this presentation here. If it's no, we can plant seeds on what a conversion is, right? How does that look? Perfect. So let's just say when I do this minimum non-MEC, also, this is really cool now. Well, I'm sorry, the second thing is that it also lowers your agent's commission. Sorry, every agent on the call. I tell this right to the client, by the way, so that when I ask them, I say, hey, if the money's not going to the carrier necessarily, it's not going to the agent, where is it going to? Into your policy, Mr. and Mrs. Client, so the money can just grow faster. This is not a secret here. It's really just compounding interest, right? I'm sure you all remember that in your accounting class in college. The professor said if you put away $1 a day from age 18 to 65, you'll be a millionaire. Did any of you listen? I didn't listen, but did any of you guys listen? So this is really just compounding interest. It's not everything. Again, it should be a piece of your portfolio. So when I do that minimum non-MEC, if you look here, it also allows me now to put in, hey, Mr. and Mrs. Client, how much money are you comfortable putting away on a monthly basis? And before you answer that question, I don't want you to put this away forever, for a lifetime. How about just doing this for 10 years, whatever you want, till age 65? This shows max distributions from 66 to 90, your retirement, and I hit the rerun button there. I'm probably the biggest fan of what I'm showing to you right here. I will discuss whole life, I promise, but I'm a biggest fan of this right here because I can manipulate the numbers and I can lower that death benefit. Is it going to benefit me, the agent? Not as much, no. Is it going to benefit the carrier? Definitely not. It just benefits your client here. Did everyone see what I just did here? Look what happened to my death benefit. It went from $1 million to here. Does everyone see that? But if I don't care about my death benefit, why is it so high? I know none of you do this, but unfortunately, there have been some greedy agents out there that have the highest commission, the highest death benefit to get paid the highest commission. So I said it. Sorry about that. So there you go. There's the accumulation, right? And as you already know, I can click on the PDF. I can go into the illustration. We can dance right here on the spot. All right. Please ask questions. I don't see any questions here yet. So ask those questions. I'll make sure I get to them there. I can't be doing that good of a job, right? Come on. So, all right. So now we're actually going to leave the VUL out. If you are variable licensed, I'd love to have a conversation with you. I do work with a lot of financial planners. It just allows you to manage the money. You know, we'll talk about it first thing. But let's go to our next one, which is whole life. Okay. Whole life insurance is very similar to your guaranteed UL because everything is guaranteed. Does that make sense? Everything is, now you do have some cash. So when I click on this whole life option here now, right? Let's just go back to $1 million just to make sure everything's apples to apples. Okay. So whole life it's been around for a long time, right? What's the biggest difference between universal life and whole life is all guaranteed. So I have a guaranteed death benefit, I have a guaranteed premium, and I have a guaranteed time frame that it's good for. And I also have, so how does whole life pay out there? It's through dividends. And really, it's almost like a current assumption where it's based on how that whole life company is doing with their internal investments. That number can go up, that number can go down. But it is, so what are you paying for? Whole life is more expensive because, again, you're paying for your guaranteed column and your non-guaranteed column are exactly the same. So if I look in here and I pick one of these options here, right? Look at everything is guaranteed. So I can see my guaranteed premium, my time, this is to age 100. Does everyone see that there? Guaranteed. And look at, here's what I'm putting in, and here's how much cash I'm gonna have after 20 years. All guaranteed. Does everyone see that? There it is. So you're paying here for the guarantees. The thing that the thing for me is that universal life insurance, so the way that things have to, like the way that cash value life insurance works with IUL, the difference is that there's a zero column. That's the biggest difference between whole life, right? The whole life is all guaranteed. With universal life, I have two columns. I have a guaranteed column and a non-guaranteed column. There's two things that have to occur for that guaranteed column to happen. I call it Armageddon because it never happened in the history of our business. But by the law of any cash value universal life policy, if there's growth, you have to show the worst case scenario. First thing, the carrier has to charge their maximum cost of insurance charges. I've already explained how that works, right? They have to charge the max every single year. The second thing, which has also never happened, is the S&P 500 has to do zero every single year. If those two things were to occur, that guarantee column would come to fruition. It has to be there by law. Would you all agree if the S&P 500 does zero for 25, 30 years, we're all in a world of trouble, correct? Would you all agree upon that? So would I. So, but listen, there are people who just want to make sure that everything is guaranteed and that it goes out for life. That's what whole life is great for. You do have two options here. You can do what's called a full pay. The other option is we can have this paid off in 20 years. Does everyone see that? Your job is not to sell people a specific thing. Your job is to educate people. When you do the right thing, they make decisions. Does everyone see that? Guaranteed death benefit, guaranteed cash value, guaranteed premium. That's whole life insurance in a nutshell. So I wasn't going to talk about the VUL, but if you do have any financial planners in the call, you have to be variable licensed for this to show up. So it will not show up Series 6, 63, 7 to use this here. But in essence, it's still a universal life policy. The only difference now is you have 100, 200 different funds you can manage. So that is an option if you are a variable license. I will not spend a lot of time there, but let me know, put a question in or reach out to me if you have more questions there. So really that's all the products on here. There is one thing that's not showing up, and I want to give you one last visual. It's called final expense. So it's not showing up because we're too young here. Okay, let's change that date of birth. Now we know a lot of people, what do we say? You don't plan to fail, you fail to plan. Well, so final expense is becoming extremely popular because unfortunately, a lot of people are dropping like flies right now. So, and they didn't plan for it. So now, take a look here. Final expense is really what it is. It's geared towards your final expenses. In order for it to show up, you have to be 45 or older. The last thing is you have to put in $40,000 or less. When I do those two things, you're going to see an option pop up here called final expense. This is a permanent policy, which is why I'm talking about it right now. Does that make sense, everyone? So when I do that, does everyone see final expense here? So I click on final expense. There you go. So it's for lower face amounts, but again, it's really popular because a lot of people are just not ready for what's coming here. So for 40,000 and less, I can get final expense. If I do 25,000 and less, now we have a guaranteed issue option. Let me hit that rerun. So now we have Gerber. People think Gerber is just for babies, but we also have that for adults as well. It's going to be more expensive because it's guaranteed issue. I just want to explain very quickly here. You have two options when it comes to final expense. The first one is a level death benefit. We're all familiar with this. This is also based on how we answer the medical questions. Level death benefit is what you're used to. I get a policy today. I can answer no to most of these questions. If I'm not here tomorrow, I'm covered for that 40 to 25,000, right? That's the first option, business as usual. The second option is called a graded death benefit. And what that means now is maybe I got 1 foot in the grave, 1 foot out. I'm not healthy. Well, the grade, and it's all based on how you answer the medical questions as to which one they pick here. If it does come up graded, then what that means is that you have to stay alive for at least 2 years. If you die within that first 2 years, you're just going to get your premium back plus a 10% residual. If you make it past the 2 years, then you get whatever that death benefit is after that. Does that make sense, everyone? So the first option is a level death benefit with final expense. The second option is a graded. You can go all the way down to 5,000 here. So there should be something for everybody here, okay? Final expense is just how it sounds. That's what it's for, to take care of your final expenses. I have someone that didn't plan, they have no insurance. What can we do here? I talked about the two options, and it's based on the medical questions, right? How they answer those questions. Fun stuff, huh? Is everyone awake? You guys excited? Hopefully I'm doing my part by keeping you on your toes here. There's a few different options here. So I'm hoping that with permanent insurance, just to recap, we talked about the basics of guaranteed UL, term for life. It's designed for a death benefit, very little cash value, and it's all guarantees, right? Guaranteed premium, guaranteed time frame, guaranteed death benefit. And then we also have our, let me move my face here so I can give you these visuals of these options here. So we talked about guaranteed UL, the most basic. We talked about universal life, having more focus on death benefit, a little bit of cash on current assumption products. Whatever that carrier is going to be crediting, that's what you get. Next step, we talked about protection IUL. Now we're using an IUL, still a little bit of protection there as well, but kind of like have our cake and eat it too. We can add our riders to the protection IUL as well as universal life. And then the next step up is we talked about accumulation IUL, strictly cash value growth. We talked about that. We talked about max funding. We talked about minimum funding, both options. We talked about whole life insurance, how it's all guaranteed. Everything is guaranteed there, from the death benefit to the premium to the time frame, right? And then we talked about VUL. So if you're variable licensed, and then the last thing we talked about is the final expense. Well, listen, hopefully this has been helpful to you all. I did offer my services to get me on a call. Who is this insurance really good for? Business owners. If you work with business owners, this is a great opportunity because they get all the same benefits as an individual, but the difference is that they can pay the premium out of their company. And when they hear that, their ears perk up. They really like that. So business owners are a great fit. I want to see someone book a meeting in my calendar for a call for this week or next week. Josh, I got a call with a business owner. I need your help. I got a guy, I got a gal. Here's the situation. Use me. I'm very comfortable here. I'm not pushy. And I have a 90% close ratio. Again, not because I'm doing anything special, just because I can educate people and show them what's going on. It helps them to make decisions much faster. I really appreciate all your time. Everyone staying on the call. It's been strong here. Please put your questions in the chat box. Love to help you out to help your clients to get some more permanent insurance going, okay? Thank you again. I'll hold on for a minute here. Thank you again to everyone for staying on the call. You have a blessed day, and put those questions in the chat box, and I'll get as many as I can answered. Talk to you all soon, and happy selling to all of you, okay? We'll give it a minute here. Here come the questions. Okay, so someone said, what plans offer living benefits? So the two companies, you have two different types of living benefits. First, you have the critical and chronic illness, which a lot of carriers have. Some of them are built in for free. Some of them have cost involved in them. I'm a big fan of the long-term care riders. And the two carriers that have the true long-term care riders are Nationwide and John Hancock. So I'm a huge fan. I did show you how to add those riders. So I'm a huge fan of those riders. The younger you add them, it makes perfect sense because you're going to actually be getting the money you put into those policies is sitting right there in cash value. So I'm encouraging people to do this at a younger and younger age because the money's sitting right there. Does that make sense, everybody? Really important to understand. Let me give you a quick visual of that. I do want to show you that very quickly here. So we're having this conversation with 30 and 40-year-olds now. So what I would do here is I would go to that, again, I'm a fan of the Protection IUL. So I would go to Protection IUL, run that permanent illustration. And then all I'm going to do once this pops up now is I'm going to go to scroll down and add that rider. Just to recap, whatever the death benefit is, it gives me a pool of money for long-term care. So in this situation, I have $1 million death benefit, right? I scroll down. I'm going to say with, by the way, you see you have other options here. You see you have chronic illness with LTC chronic. If you want, I would just pick long-term care riders. Don't go with anything else. That's the best of the best. I don't want to pay this forever. I can do a 10 pay. I can get up to 4% of $1 million or up to $40,000 a month to pay for long-term care. I hit the rerun quote. And I'm gonna pull up this PDF because I want to show you why this is really good for younger people. So I got Nationwide, John Hancock, right? So have a look here. I'm gonna dive down to the meat and potatoes here pretty quickly once this PDF comes up here. Okay, can you all see that? I mean, the ability to be able to control the situation here in front of your client is amazing. And they ask questions too. So here we go. So let's look at this hypothetical here, right? I'm going to keep this very simple. So we got a male, 44. So again, we're talking about long-term care at 44 now. How's that possible? And I'll show you why. So here we go. We're putting in this $18,500 a year for 10 years, so $185,000. Now this is my cash value growing in my policy. Here's my IUL at 5.74%. And I scroll down. So look, we put in 185 here. Let's look at this Let's look at John Doe's retirement age. It's 65, right? So in this hypothetical, I put in my 185, right? Is everyone with me here? Look how much money is sitting in cash value for retirement income here. Does everyone see that? I put in 185. I have almost 300K sitting in my bucket, my cash value non-reportable tax-free bucket here. So the younger you are, so I don't want to say the word free insurance, but do you see what I'm talking about here? You're only putting in 185,000. Why does this look like this? Because you have time. Is it the same way for a 60-year-old? No, they don't have the same amount of time. Because look at this person has 21 years of compounding interest. If they don't use this money for long-term care, which they have $1 million pool, they can use it for their retirement income. So the key thing here amongst traditional insurance is that no matter what happens, the benefit's going to be used. Does that make sense, everybody? Traditional long-term care, you could pay for it for 20, 30 years, never have a long-term care issue. All your money is gone. And that's really expensive auto insurance. This is the product of the future right here. Does anyone know what happened in the state of Washington? They made it mandatory to have long-term care like they did in California for health insurance. It was pandemonium. If anyone's on this call here who was in the state of Washington, they'll co-sign for me how crazy it really was. It was unbelievable. So if you look here, in this hypothetical, if the person is 40, guess what? It looks even better. This is what you call have your cake and eat it too, because you have a death benefit. You have the pool of money for long-term care, which we call a living benefit. What could I get while I'm alive? And we have the cash value, which is another living benefit. I should see like 5 policies being written as we speak. You guys should be off. You should use your other screen and be calling clients to talk about this. Okay, we've got more questions coming in here. So someone said, can you explain the primary difference between whole life and guaranteed universal life? So the biggest difference between those two, because that's a great question, because they are very similar, right? The biggest difference is that guaranteed UL has no cash value. It's not designed for cash. The whole life does have cash value. That's the biggest difference, because besides everything else, they're all guaranteed, set death benefits, set premium. Everything else is guaranteed. The biggest difference is whole life has cash value built into it. A lot of people think whole life is just means for your whole life. No, it's an actual product, whole life. It's been around for a long time. See, IUL has been around probably for about 15, 20 years now. So that to me, they saw what was going on. And they created something that was, to me, in my opinion, was a better option. But again, you have some conservative clients that don't want to talk about guarantees versus non-guarantees. I get it. We have something for everyone here. That's a great question, by the way. So here come the questions. Someone said, please re-explain why business owners are a good candidate for the IUL insurance. Okay, so again, a business owner is the same as a regular person. The biggest difference is that premiums can be paid for out of the business. That's the biggest difference. A business owner still needs to create non-reportable tax-free income, right? A business owner still needs to have a death benefit, God forbid he's not here. The biggest difference, though, is that usually there's money in the business, and they can pay the premium out of the business. That's the key factor as to why business owners need long-term care as well, right? They need all this coverage, but they can pay the premium out of the company. That's why it's a good fit. I had a testimony of a case where I helped an agent. It was going to be a key man buy sell for 2 or 3 partners, right? And we were on the call. I took care of the protection need first. I didn't go in there trying to sell anything. And so it was about a $2,000 or $3,000 premium, not a bad case, right? Well, I just asked them a simple question. Are you guys putting money away for retirement? Are you saving money? We have money in our business. Okay, perfect. So I went over the same exact strategy with retirement income as well as long-term care. It went from a $2,000 premium to a $25,000 case. And it's not that I just told them what was out there and that they could pay for it at their company and boom. we have a sale. And both those cases went through. So you just have to ask the question. Don't be afraid to ask. And you'll see the results will come in. So someone said on the turn policy, is there a cash return option? So we do have what's called ROP for term insurance, return of premium, which you can get every dollar back that you put in. It's going to be about 3 or 4 times the amount as what you would have paid for that term insurance. So in certain situations, it does make sense. Let's say I've seen cases where you have a brutal divorce, right? And by the rules of the divorce, the husband has to have life insurance. Well, the husband kind of wanted to stick it to his wife, so instead of doing term, he did return of premium. So if he makes it pass, he gets every dollar back. That's the only real situation where, I mean, there could be others, but that it makes sense. Because look at, would you want to take your money and bury it in the ground and pull it up after 30 years? Or do you want to be able to have some kind of increase, to have some compounding interest, right? So that's a good question there. Got a few more here. Oh, there's someone talking about a real case here. This gets me excited. I have a 60-year-old with 750K of term and 250 of whole life. Should we drop the term and put the 190 premium into the whole life? It just depends on where that person's at. Listen, I have $4 million of term insurance. I have also just had my 5th child. So if I'm not here tomorrow, my wife's in a world of trouble. I'm the breadwinner for the house. So term insurance provides a great need. The question is, when do I want to move from term to permanent? As soon as you have the ability. I can convert. I'm at a preferred best for $4 million. So I can convert that whenever I want for that length of the term or up to age 70, whatever comes first. So it just depends if it sounds like the person, if they need that death benefit, then for term, I would keep it. If they don't, I would 100% look to convert to a permanent plan. I'd love to talk to you about that offline if you want to have a conversation there. I'm happy to have that conversation with you. I love having these conversations though. Don't be afraid of, all you have to do is ask your clients, what do you currently have? Let them tell you what they have, and then you can reach out to me and we'll go over it. You're really just fact finding. That's really all you're doing here, okay? All right, one more question here. So here's a good question. If someone decides to pull money out of an IUL because they can't no longer, pay the premiums, do they get back all the money they put into or a percentage? How does that work? So with most of these contracts, we have what's called a accumulation value. So if you look here, let's look at this hypothetical here, okay? So I have an accumulation value. That's what's currently growing in the policy right now. So an easy way to figure out what their fees are, take this 18,500, that's what they put in, right? And subtract it from that 14. Those are the cost of insurance charges year 1. So to kind of answer your question, my surrender value is what's currently growing as if I want to take every dollar out of the policy. So if I say, hey, I want to pack up and run here and take all the money out, how does that work? Well, if you look here, because of the cost of insurance charges, this would not be a good investment if someone wants to put this in and take it out right away. So eventually this starts growing. And if you look here, at some point, let's have a look when this is. At some point, this number is going to be even. Let's see what year it is here. So you see at year 16, does everyone see that? So now what I know is by looking at this, I know that my surrender charges are going to be gone at that point. So I'm not going to take a hit anymore if I surrender this policy. Every carrier is a little bit different. Most of them are anywhere from 10 to 16 years. But you can look at that in the illustration and see it right there. After that, you can take all your money out here. And, now I don't recommend you cashing the policy out completely because look, we put in 185. If you surrender the policy, there is taxes there, right? There will be, capital gains because you're putting in more than what you're taking out more than you put in. What I tell people is that you're never going to surrender this policy for the rest of your life. Why? Because what is the death benefit if someone passes away? The answer is tax-free. That's the answer. So if you never surrender this policy and you take all the money out of the policy, you're never going to have to pay taxes on the gains in the contract. Does that make sense, everybody? Really important to understand. Now the questions keep coming in, and I want to answer all of them. So listen, let's do this for time's sake. It's been 55 minutes. I really appreciate all of you. Please reach out. I'd love the chance to go over. I see there's some more cases in here, so I'm definitely going to look at this and we're going to reach out and go through these cases, okay? I really appreciate all your time. This has been helpful. I'll definitely do another one of these. I like how everyone's staying on here and listening in, so great. Thank you so much for your time. Everyone have a blessed day, and let's see if we can make some more permanent sales happen. Talk to you soon.